You know what? I feel like we have a sizable audience that's already joined. So let's get rolling. And again, welcome everyone to this Placer AI webinar 2022 halfway point lessons. We are very excited to be doing this today. A quick introduction to what a quick look at our agenda, at least, of what we're going to be doing today. We're going to start off with a very brief introduction to Placer for those of you who are unfamiliar or new to us. We're going to start by looking at challenges and solutions, which is how we're going to look back at the first half of the year, and then exaggerations and surprises, things that kind of caught us off guard or things that we really liked. And then we are going to dive into both what this meant looking back, but also what things mean looking forward. So, and then finally, as always, we will make sure to take your questions. If at any point throughout the webinar you have a question, please plug it into the Q&A button at the top or bottom of your screen, depending on how you have Zoom configured. I am thrilled to be joined today by the inimitable RJ Hottovy, our head of analytical research here at Placer. RJ, this is always the best. How are you today?
Yeah, I'm doing well. How are you doing?
Doing great. This is kind of like recording the conversations that we normally have.
Exactly.
But so a quick look at Placer. How do we get the data that you're going to be seeing in the background today? So Placer observes a panel of over 30 million devices throughout the United States. Very critically, this is all anonymized aggregate data, so we are GDPR and CCPA compliant. We then utilize that data to run our machine learning and AI algorithms to make estimations on retail visits across the country to retail locations. We then present that in a wealth of different reports within our platform on everything from the customer journey, visit counts, void analysis, and a whole lot more. If anyone is interested in learning more about our data, please check out our free tool, which is at placer.ai. You can sign up for the free version of our premium product, or check out our free tools in a section on our website called The Square at placer.ai-the Square. But now we get into the data itself. And I think it's, we just dive into it, RJ. So let's start with maybe the kind of key topic that we have been discussing over the last 6 months of one of the huge effects on retail to start off this year. And it's inflation and gas prices and this kind of array of challenges that the brick and mortar space has faced. And so I guess let's start with what made these challenges unique? What are the big takeaways from how you've seen retail respond? And what do you think the impact will be moving forward?
Yeah, I don't think it's a surprise that inflation, both gas, food, even if you want to go as far as rent, I mean, I think that was the single biggest factor on both consumer behavior and how retailers went about their response. I mean, coming into the year, a lot of questions about supply chain and other issues were going on, but really inflation took center stage as we moved into February and March. And I really think it's led to a lot of different behaviors. And to your point, it's challenging because there's consumer behavior across each one of these categories has been different. I mean, if you look at groceries, what we're hearing from all the grocery store operators is that actually people are coming in more now, but spending less just because of inflation. They're making more frequent visits, but spending less. So how do you adjust to that? We've seen a trade down. We've seen QSR companies starting to benefit from it at the expense of full service dining. Certainly an impact there. Gas stations themselves, we've seen a lot less visits to gas stations, although in some cases it's been a benefit for those companies like Costco, which are perceived to have the lowest price gas. On top of it too, I mean, one of the themes that we saw across COVID was that most retailers' trade areas had expanded. More people had more time on their hands, would travel further to retail locations, particularly if they wanted the particular product. And that's somewhat reversed too. We're starting to see trade areas shrink with people being more selective about the visits they've had. So it really, I mean, the response has almost been, you almost have to look at category by category what's going on here, different things and different reactions and by consumers. It really bifurcation too. I think that the impact has been more felt by lower income consumers, and certainly driving a lot of the visitation data that we see on the screen. But on the flip side, it's also changed somewhat behavior, or at least even at the high end, we're starting to see some changes behavior with that group as well.
Yeah, I mean, it's so important, but I do think like one of the things, and we've discussed this quite a bit, is it's not all bad. And I think in some cases, when we look at challenges like this, we have this tendency to say, there are really significant challenges, but to make it seem like it's everything that's being affected. I mean, we've seen obviously significant negative responses to some retailers that are actually doing quite well. Yeah. I mean, what are your takeaways from like the performance and I guess and the backlash against companies like Target, Walmart, and others?
Yeah, I mean, I think it's very interesting because your boy, I mean, if you're looking just from a Wall Street perspective here, Target, Walmart have been hit hard. The sales numbers for the first quarter didn't come in where people expected them to, but largely that came in through a couple of categories. And I think apparel was one of the big ones too, where it took so long to get through the supply chain backlogs that we saw late last year. By the time it came in, what people were looking for, they weren't looking for cozy, comfy wear, the things that we were wearing during COVID. They were looking for performance wear or out on the town, occasion-based wear. Now, not every category was doing that, but certainly that this inventory overhang that a lot of the retailers were left with caused a lot of concern. But at the same time, if you look at the visitation data, across the rest of the product categories, or at least for Walmart and Target, the visitation data that we've seen there, these guys are holding up very strong. I mean, and we do typically see a migration to superstores and mass merchants when we start to see a bit of a cyclical downturn and economic concerns. And I think if you take out some of the apparel inventory mismatch, these retailers are doing quite well, and they're responding very well to what consumers are looking for. The value messaging is resonating, and I think that maybe it's a bit of an overblown overreaction on a lot of the markets right now.
I also feel like we need to make, when we look at things, sometimes only through the lens of, again, by no means should anybody be asking me for stock advice, right? But I think sometimes when we are, the perceptions of the narratives are very skewed by things that are looking at the stock. But when you see things like, margins are thinning, but sales are up, if you're looking at the overall health of a Target or a Walmart, the demand is clearly there. We're just in a really unique environment. I mean, I feel better about the long-term potential for these customers than, for these companies than I would, and I almost have been in the past, because of their ability to kind of serve audiences in a difficult period and really be there for their customer base.
I couldn't agree more. I mean, I think visitation data is probably the single most important indicator of future health for a business, because once you have that, you've shown that you have demand for your stores or your product. There's a lot of things we can do with that. If you keep that experience healthy, you're going to continue to see visit frequency, and there's a ways to monetize it over time. I mean, there may be a short-term trade-off in margins to bring people in, but those retailers that really bring the experience and can show visitation frequency improvements, that generally portends future health of the sales growth for a business here.
I think one of the areas, though, I mean, so if we think there's some areas where it may be a little bit overblown, I think there are other areas that have been like a really difficult situation. And I think restaurants, but especially full service restaurants, fit within that category in the sense of almost this perfect storm of challenges. We saw this recovery at the end of the year. They look like they were doing better. Then Omicron happens. And where they look like they're coming back, and then we see inflation in gas prices, which are, limiting the amount of money that the average consumer has to spend. I mean, how do you see this specific sector performing in the second half of the year? And, almost the counter for that, when you think of like who benefits is QSR, is there any kind of ceiling to how good of a back half QSR could have as a result of what's going on?
Yeah, it really is a situation where particularly full service restaurants can't buy a break right now. I mean, that's been obviously the most difficult situation that these restaurant companies have ever had to deal with. And frankly, a lot of them didn't survive. There was a great article from the Washington Post out a couple of weeks ago saying that 70,000 restaurants, and that was largely skewed towards full service restaurants, closed permanently during the pandemic. And obviously we have seen that pressure, seen less visitations for full service dining, although interestingly enough, I've seen some data that shows that the average ticket is still up for these full service restaurants. So when people do go out, they're going out less, but when they do go out, they still are indulging a bit. So that is interesting. It kind of shows this bifurcation among kind of higher end consumers versus lower end consumers. QSR is an interesting question to get back to that particular category. Obviously, this is a group that's learned and implemented a lot of things that happened during COVID, this massive shift towards digital ordering and, in some cases delivery and drive-through in a lot of cases too. A lot of the QSRs have really done a good job not only adjusting in new stores or remodeling stores to really accommodate those kind of mobile order and really kind of that quick order type situation. Typically what we see during a cyclical downturn, it's not surprising, we do typically see a trade down to QSR, but it does have limitations. If this is a prolonged cyclical downturn, typically what we see is then there's even another layer down of either trade out or trade down to things like C stores, particularly too, when we've seen a lot of price increases at QSRs too. That's going to be a delicate balance that these QSR companies have to manage with, is that right now there is a barrier, there is limitations on how much you can raise prices because there will be consumer pushback. Typically, they have not seen that. Typically, their consumers are quick to adjust, but I think in this day and age, when inflation is hitting on so many different fronts, there will be some limitations on that. So I do think back half of the year, QSR is going to outperform full service. I don't think that's a huge shocker to say that, but I also think that it's going to be interesting to see how they adjust. And there's certain things that they're going to have to deal with too, particularly on the labor shortage front. I think that's still the number one issue that's facing a lot of QSR companies in terms of delivering an experience and getting throughput through, particularly at the drive-through.
It's a really good point, and it is a huge challenge. I think one thing that we've talked a lot about is kind of store fleet optimization. We've seen major headlines in this topic. Rite Aid, JCPenney, Macy's, kind of name your brand almost across spaces, and we've seen, hey, we're going to lower our store count. But I think there's different ways of looking at it. So when fleet optimization as a topic is a little tricky, because sometimes it's seen as this like euphemism for things are going terribly, but it probably is more than that. Why do you think this trend is so important? How far reaching do you think this kind of push to optimization is?
I mean, I think if nothing else, the migration patterns that we've seen and during COVID, and somewhat it stayed somewhat consistent even after COVID. I think first and foremost, that's probably enough of a motivation for store fleet optimization, is that your trade areas have changed. They've shifted for a lot of retailers. The trade area that you had when you built that location may not be the same as it was today, and so there may be some reasons to close stores. Particularly maybe that market has seen a net migration loss. Maybe you consolidate from 20 stores to 15 stores in a given market because you can better accommodate them. I do think it's very interesting that we're seeing this visits per location for a lot of these chains that have chosen to optimize go up. So you're able to better serve, or at least in a lot of cases, you're able to serve the same amount or even more customers with fewer stores. Now, some of this is obviously we've talked about omnichannel quite a bit in past webinars, and I think a lot of that's a byproduct of being able to serve customers better through an omnichannel approach. But it really is interesting to see the success that a lot of retailers have had by growing by shrinking, if you will, here, and really being able to optimize that. And I think that's going to be an important trend, is being really selective and surgical with your real estate decisions going forward. Really taking a hard look at that trade area, knowing how many people are there, but also the makeup of the people that are in that market to better understand where the best locations for your stores are.
I think also, like, one of the things that we don't talk enough within this kind of fleet conversation and right sizing, et cetera, is the idea of like multi-format.
Yeah.
I think one of the big kind of slaps in the face for me was when I first got to Placer, was analyzing Lululemon, and there was a lot of stores in a very tight region. We looked at Chicago, like really tight, tons of which should be trade area overlap, and yet Lululemon continues to thrive even though they had that in many regions. And you kind of look into it, you're like, oh, their formats are really different, which allows them to hit certain markets with tremendous effect. I think it's something we need to see a lot more of. If you have a store that's going to be a massive, department store like a JCPenney, you need a lot of space. But if you're a brand that can do multi-format well, think Target, think Lululemon, think many others, it gives you a lot more ability to bring the right type of offering to the right place. Even like a Bloomies for a Bloomingdale, like this idea of these concepts and these different formats and concepts, they give you the ability to maximize your reach to a specific market in a different way. And I think there's a really exciting upside there too.
Yeah, I think it's almost a Starbucks example here. Understanding the need state. Starbucks for the longest time built its brand on being this third place, being a very experiential, this place you could go sit down with a friend and have a cup of coffee. But as we saw through the last decade or so, mobile order has become part of our everyday lives, and people want that convenience aspect. And Starbucks, it took them a while to realize, but they realized that we can segment our store base. We can have locations that are still experiential, this third place. Typically they're going to be larger format, but some of our smaller stores, we're going to take out the seats. We're going to make this much more oriented for that mobile order customer. I mean, I think the early days of mobile order, we can all remember that, you come in and there's a line of 20 people waiting to get their mobile order. And I mean, in a lot of cases, it just didn't work and it killed the experience of those locations. And when you try to do too many things, you try to be an experiential retailer and you try to be a convenience retailer all at once. Honestly, typically you don't do either well. And you kind of put both customer bases at kind of odds there. So I think the key thing is really understanding the need state that you're serving with each store. Some are going to be more tourist focused. Some are going to be more traditional focused. I mean, there's a lot of different things. Understanding that need state. Why are consumers coming into that particular store? So important in this day and age.
Starbucks is such a great example. You think they have, whether it's Roastery, the large format stores in suburbs, they have really small format stores within major cities. They have these community oriented stores, and all of them bring different types of audiences at different times. And it gives them a much wider array of tools to reach their audience. And I think it's such a great example. But a question came in that I want to address. Please provide an example of the difference between a full service and a fast casual, e.g. steakhouse versus Chili's. Is Chili's a fast casual restaurant? I know it's a technical question, but still we should address it.
Typically, Chili's would be included in full service. And now there's layers of full service. You have your fine dining, your Capital Grille type restaurants there. You have family-oriented restaurants. You have, more casual dining, which I'd say Chili's and TGI Fridays and, Cheesecake Factory would fall into that bucket. So I would include Chili's as a full service restaurant. Now, obviously, we could break down that even further and done some category work on that. Fine dining has generally outperformed some of the other categories. Not surprising, is that customers held up well, and there still remains some business travel. Fast casual, typically the way I think about it is something where you're ordering at the counter, but it's a little bit more upscale than what you see at a QSR. So that would be your Chipotle's of the world, your Sweet Greens. Now, obviously, that paradigm has shifted with mobile ordering as well too, and those companies have really embraced that. But that's typically who I put in that group is your Cavas, your Sweet Greens, your Chipotle's. Typically a little bit better quality product than what you'd see at most quick service restaurants. A little bit higher price points as well, but typically still kind of the same where you're ordering at the counter.
Yeah, and definitely it's a great question, and please keep them coming. But I do think even when you're looking at industries, it's very important when we do industry analysis. It's obviously important, brings a lot of value, but diving deep into each specific chain often shows you very different things and specific locations and regions. So we're definitely seeing trends because of the industry with that industry level view, and it's an important view to have, but also it's definitely not a one size fits all situation, and for any of the kind of things we're talking about today. I mean, with that, I want to, something that has been really interesting is that, especially, I think where we were, a year and a half ago, we were seeing a lot of brands talking about expanding their retail footprint. And there was this idea that, oh, they're doing it because, prices are down. And that's not necessarily the case, yet we are seeing many brands really expanding and expanding aggressively. What are the examples from expanding brands that you particularly like? And what are the wider lessons for other retailers from these brands?
Yeah, I think it's interesting too. I mean, one of the themes that I think is fascinating is this idea that it's not only small formats, but in a lot of cases, it's also smaller markets too. This idea that maybe a market that's sub 100,000 population, even in cases below 50,000 population, markets that typically you wouldn't have gone because the economics don't work in those markets. Maybe you can because of migration patterns. The population's expanded, but it's also cheaper to operate these formats. You get your pick of labor in these markets as well. But I think also too, I mean, even if you segment it within markets too, some of these smaller markets maybe are better fit in a particular neighborhood too. We have seen a migration away from some of the urban business centers, although urban residential is something that we've seen recover. And I know we're going to touch on that a little bit later here, so I don't want to get too far ahead of myself. But some of this idea of neighborhood retail is an important thing, and we're seeing a lot of retailers see success on some of these smaller formats and maybe fit into a neighborhood setting as well. So I think that's one of the more fascinating trends, is that some of these trade areas or areas that perhaps you wouldn't have explored in the past, situation has changed, and they become a lot more feasible in some of these markets. Smaller format, and to your point earlier, understanding the need state, the format that you're going to use in a neighborhood market is going to be a little bit different than what you would use in urban or suburban locations as well. And by kind of neighborhood markets, I'm kind of thinking on kind of the outskirts of urban areas as well here too. That's where I think a lot of these locations have been placed, and some really compelling economics in these too. Again, places that a lot of retailers wouldn't have thought about exploring just a few years ago are really opening up some attractive opportunities.
That's super cool. I am really interested in like the why we see the decisions that we make, whether it's the expansions or kind of right sizing. Like, to take the example we saw with CVS, they announced they're going to be lowering their store count. When you think of their shift to more service oriented, and therefore the draw that a store has is less about, I need to be where you are when you want to buy shampoo, or to this is a place where I'm willing to go because there's a service provided there, so there's like more of an incentive, and so I can be more optimized. I think asking the same question of like, why are brands expanding? What's the strategy behind it? You think about like a Dutch Bros, you see such dominance within such a tight area. Like, oh wow, this model makes a lot of sense. You understand why they're expanding. I think there's, it's pretty interesting as to kind of what is the calculus that goes into how do we decide when and where and how aggressively to push new stores.
Yeah, I mean, I think a lot of it comes down to visitor frequency. I mean, I think you can trace that back for CVS and Walgreens, how they're changing the way they're thinking about their real estate strategies. And again, another situation where they're shrinking to grow. They're shedding a lot of the redundant locations, particularly in smaller markets. And if we look at the CVS closings, what we've seen is most of these locations that have already been closed, and they've already closed over 100 of the 900 that they plan to close, they were underperforming. They were underperforming stores in markets where they were probably overstored to begin with. A lot of the stores we've seen in the Midwest right now, that's where a lot of the closures, although we've seen some in San Francisco and in other urban markets that have seen a net migration away too. But I think the idea here is that they can ultimately get greater visitor frequency out of these locations, particularly the ones that are going to have the healthcare focused adjacent locations with it as well. I think that's one of the key lessons, is that particularly in COVID, when consumers focus on health and wellness as first and foremost, there's a lot of I think there's a supply demand imbalance, and I think these drugstore companies realize it. Same thing with Dutch Bros. I mean, I think they've been smart. The markets they're looking at are underpenetrated, and if you look at coffee as percentage overall dining transactions or visitations, the markets they're going after, they're very underpenetrated, and so I think they've been smart. I think that they can jump in and capitalize and really boost this visitor frequency number in these things too. So I think the decisions that are being made, it's just really comes down to, can I get not only attract a customer, but can I keep them coming in at a pretty rapid clip, more so than other areas of the country? I think that's kind of the calculus, in the simplest form. I mean, there's always a number of other reasons, and it's really a case by case study. But I think driving visitor frequency, keeping customers keep coming back, really makes a unit economics for a lot of these retailers work.
Yeah, it's interesting. Staying on this topic, we had a question come in, and it basically says, so CVS and Walgreens are doing what Sam's and Walmart did a few years ago, closing overlapping stores. And I think the answer is that part of that is yes, but also I think there's an element here of they're shifting their model too. So yeah, you want to close underperforming stores, but if I'm a CVS and I'm focusing on these health hubs, if the trade area changes as a result, depending on what I'm looking to accomplish within that location. So a mall has a much bigger trade area than a grocery anchored shopping center most of the time. And I think that's because of the nature of what I'm going to accomplish there. I think that when the pharmacy becomes a place that's not just get in, get out, and with things I want, but it's a place where I'm going to spend a more extended period of time for a service, I'm going to go a little bit further for it. And I think that shift is what's fascinating in this space.
I agree. I mean, I think, and that service aspect that's the key word there, because when you start to layer that in, that gets margin accretive. I mean, that's where, you not only drive repeat visits, but you also do it at a higher margin than what you would be doing, for a typical transaction there too. So I think that's the important thing. When you start to layer on these service offerings, there's a lot of ways to monetize that. And we've seen success stories across retail with kind of being adjacent services that you can offer. Your revenue per visit really starts to go up. And I think that's a, clear path to profitability, even if you're making investments early on. It may not be immediate, but I think that if you look at the margins that that CVS and Walgreens are talking about with their stores, some really impressive stuff. If you look kind of the ramp for some of these health hub type locations.
Very. I mean, it's super interesting. So another trend that we kind of have to discuss is trading down. Very simply, how big of a deal is this phenomenon? Who benefits and who loses out?
It's interesting too, because the timing of the trade down too, we're seeing this big, spike in inflation. At the same time, we're lapping a lot of the stimulus-driven, visitations that we saw last year. I mean, first and second quarter last year, we saw a lot of traffic to what I'd say more discretionary retailers because a lot of consumers had additional funds, discretionary funds to spend. Now we're in a situation where inflation is becoming a bigger issue. There's kind of a wealth effect story here with some consumers feeling less wealthy because of what we're seeing in the stock markets and the equity markets. And so I think that I think a lot of retailers, particularly those that do skew more to the discretionary side, have to be smart about the way they go about things in terms of inventory management at this point. I do think trade down we're going to continue to see in the back half of the year, so that benefits kind of the value price retailers as well. I mean, we've started to see indications of that not only in grocery but also in other within categories too. We've seen discount and off-price apparel generally outperform kind of the overall apparel category, and I think that's going to be a trend that continues. Some of that is inventory related too. With we talked about the inventory mismatch. When inventory did finally arrive, it came in a situation where consumers may not have been looking for that particular inventory, so there's an inventory mismatch as well. But I think right now, I mean, trade down is going to be a persistent theme in the back, or at least for over the next couple of months. The one thing that I do think for higher end, we have Macy's on this. The one thing that is kind of still helping out a lot of the higher end, retailers is that consumers still do feel good about housing prices, and that's one of the things that's kind of mitigating some of the wealth effect issues. I mean, maybe your stock portfolio is down, but you still feel pretty good because your house is 20% above where you paid for it. So at least at this time, I think that that's going to at least continue to drive visitations for some of these high end retailers. But also, for that lower end consumers that's looking to stretch household budgets, we're going to see trade down to some of these lower price channels as well.
Yeah, that's a super kind of important point. I think the interesting thing that'll come later in the year is last year we saw this really interesting phenomenon where a lot of retailers didn't need to mark down prices to get demand during the holiday season. And that was just kind of because they didn't have enough inventory, et cetera. I wonder if that was something we were like, oh, this could be a real changing pattern that could bring them long-term value. I wonder if the current economic environment plus this, concerns over inventory maybe having too much this year will produce the opposite effect and maybe mitigate some of that strength that we're seeing. But I think we'll only find that out in a couple of months.
Well, we're already starting to see signs of it too. I mean, I think if you look last week, it was kind of a tough week for a lot of the home furnishing retailers talking about, seeing changes in demand and being over inventoried too. So, I mean, I think, home furnishing is a category where there's concerns about mortgage rates and overall environment on that too. So, I mean, I think home furnishing is a category we're going to start to see some promotional activity. We're just starting to see even indications on full service setting. I know we talked about that earlier, but typically we haven't seen a lot of discounting there, but to drive traffic, we're starting to see the kind of return of family and value menus starting to reemerge here after haven't really seen that since the beginning of COVID. So I think you're right. I think the promotional environment that we're seeing for a lot of retailers, that could change quite a bit as we move from the first half to the second half.
Yeah, I mean, absolutely. So, I mean, a question came in. What we're looking at is it's usually marked, but this is year over 3 year in the bottom, and it's year over year in the top right. Depending on the category, we're looking for the thing that tries to show where it was last year. So there's some categories that were really still way down, so that if you look year over year, it looks exaggerated. Other places that were way up. So trying to find the right mix. We're still in that period of, is year over year the better metric? Is year over 3 year the better metric? I don't know. At some point, hopefully we'll be. That's a perfect segue. Everyone's just back to year over year.
Perfect segue to this next slide here. So,
exactly. I mean, but you know what? It is, because the challenge with year over year metrics in so many cases is it's unbelievably misleading. And so I think it's been I wonder if we'll carry the same sensitivity forward. And I think it might actually be helpful to moving forward, not to be as rooted. Yeah. But let's start. Well, now we get to go to a positive story. Fitness was a segment that we saw already starting to show some really interesting signs of strength by the end of last year. And then this year, you kick off the year with Omicron and you're like, oh no, it's kind of the worst of all worlds. Like this is a big month for the fitness sector that normally sees the bulk of its, its biggest visit months in Q1, post that New Year's resolution. Yet the rebound has continued. It's shown incredible strength. Why do you think this rebound is so special? And what are the lessons for other segments that have been put in difficult situations moving forward?
Yeah, I mean, before we start on that, I mean, this is one where it's really difficult to show that year over year because, I mean, this was still a category that was subdued. So the year over year numbers on fitness, I mean, just off the charts in a lot of cases here too. But to your point, I mean, looking at the year over 3 year, I mean, I think that's the very interesting takeaway. We're now above 2019 levels. Some of that's a byproduct of unit expansion. Groups like Planet Fitness have done a very good job. Not only Planet Fitness, but groups like Blink Fitness and Choose Fitness, they've done a good job, on that as well. So people recognize the need and almost just wanting to get out of the house and be do fitness in a group setting. But I think it's really the value priced fitness clubs that are doing well, the ones that have this low monthly fee. Those are the ones that are really resonating with consumers right now. Not to say that there aren't some high fitness clubs that are doing well, but I think that just shows this demand and this need for community and group activity is really important. And I think some of it too is the way of these businesses have evolved too. A lot of it, there is this digital aspect to a lot of these businesses too that I think is so important. It's not just being able to meet in person, but you also have access to digital content offering and classes for a lot of these retailers too. I think that helps to overall keep customer satisfaction up high, and actually those, the ones that have really done a good job of digital, and I think some of those are on the upper right graph here, they're the ones who've seen the highest visitation numbers here too, the ones that have really started to integrate a digital experience with their platforms. And it really becomes an omni-channel within fitness, which is something I don't think we would have thought of just a couple of years ago. Having a digital platform really helps to drive the physical side of the business.
Yeah, absolutely. I also feel like it is this, interesting. I'll try to, and then we'll go to this. A great question just came in. I think it's kind of this real cautionary tale of don't be too quick to judge a situation. And by the way, I think we're seeing the flip side now of, again, 2 years ago, goodbye gyms, we're never going to go again. Why would we ever leave our house? And now we're at this point where like, digital fitness, that's terrible. Like, Peloton, goodbye. It's never going to have any value. I mean, that's not the case. There's going to be a balance here. And one of the things we're hearing, and this is anecdotally, is that there is a lot more focus on multiple channels. And part of the reason I think we're seeing value-oriented chains like Planet Fitness, Crunch and others do really well is because they fit into this. I want a gym membership. I want to do classes. And I also want something at home too. With that, I want to get to a question that just came in. What do you think about more trendy boutique fitness clubs and where they stack up?
Yeah, it's an interesting question because it has been popping up a lot too with some of our commercial real estate and retail customers, the groups like Exponential Fitness and Orange Theory and groups like that. I'd say it's kind of a mixed bag right now. Some of the concepts within that portfolio, and for an Exponential Fitness, they've got groups like Club Pilates, Yoga 6, Stretch Lab, concepts like that. It's been a mixed bag. I mean, some of the concepts within that portfolio are holding up okay. I'd say the more yoga focused ones have been doing okay. But some of the other ones within that, and Stretch Lab has actually been we've seen a lot of that's remained very high year over year in terms of visitation data as well. But some of the other ones within that too have not seen trends hold up as well. And so, I mean, some of that might start to be that trade down. Typically when we start to see that cyclical downturn, that middle income consumer really thinks about that health club membership. If that high price point, that kind of $50-$60 a month kind of price point, is it worth it? Can I get the same kind of benefit from something that's more affordable? So we do typically start to see that decision becomes a bigger factor when inflation and cyclical downturns happen. So I think it's kind of a case by case study, a case by case basis. There are some things that are doing well, but we are starting to see some signs of weakness among kind of that trendy boutique, fitness concept right now.
I think it also really depends on location. Like a lot of these kind of trendier groups are definitely, there's a big push in like urban areas, and some of these urban areas got hit really hard and they're not recovering as well as others. And so that kind of where you're locationally oriented is really important. I think, especially when we were talking about like trendy, more boutique kind of fitness concepts. Another topic that I think, bears talking about, at length, but definitely at least a little bit here is kind of the strength that we've seen in luxury. Like we saw this initial bump. I, very intelligently said a year ago, no, that can't last. This is just a unique, it's a unique product of the current environment. Yet we are seeing luxury strength, especially relative to many other segments, stay really strong. Why do you think that is? How long lasting do you think the success will be?
Yeah, I think it comes down to bifurcation again. That higher end consumer generally still feels pretty good about the way things are. Yes, stock portfolio being down, equity markets are down, quite a bit this year. But at the same time, too, you feel good about what the value of your home, and you're also in this mindset too that things will eventually come back, like they have, with other cyclical downturns. So that group is feeling pretty good. I think what has been interesting too is that a lot of the luxury retailers are starting to realize that their consumer trade areas have shifted quite a bit too, and starting to explore markets that they would have never gone into, and some of these smaller markets where we've seen migration to, and so I think that's interesting. It is interesting too to look at this chart. I mean, yes, luxury is held up and is holding up better than a lot of categories too. But looking at the June numbers here, that's the first time we've seen that being down year over year 13%. That could be something to keep an eye on too. Maybe starting to see a little bit more restraint among the larger consumer here too. Again, I think it's category by category. I think there's certain groups within there. I think jewelry, last time I looked, was still holding up okay, where maybe handbags, maybe, seeing a little bit less traction with too. So I think, again, it's a situation where it's hard to kind of look at everything categorically all the same here and looking kind of within subcategories. But yeah, to your point, luxury has held up well. And I think a byproduct of, that consumer feeling pretty good. But this is also interesting to kind of keep an eye on this trend and see where it goes from here.
Yeah, I mean, I do think you're going to see some fall back to earth, but I think it's going to be really interesting, and it's also going to be case by case. It's not going to be equal everywhere by any stretch. Yeah. I mean, another segment that I think, like the digitally native brands, I think we went from being, oh my God, these are the greatest things that have ever happened to retail, to like, I think in recent months there's been this very strong, backlash of like, oh, I guess they don't have it all figured out. I mean, what is, in your perspective, the real kind of analysis needed for these players and their continued offline push?
Yeah, it's interesting too, because you're right. I mean, these went from in a lot of cases, if we're looking from a Wall Street perspective, they went from kind of the darlings of the consumer space to being shunned, and a lot of questions about the viability of these models, particularly when a lot of them were running at negative earnings, certainly negative EBITDA at this point. So, the question, how do these companies go forward? And I think the key message here is that I think, particularly changes in IDFA with Apple and the way brands typically have targeted consumers, the customer acquisition cost, particularly in the digital front, has gotten a lot more expensive, particularly as compared to just a couple of years ago. And so I think that maybe we're starting to see some visitation trends, sputter a bit for these companies. It really still comes down to needing physical storefronts to drive customer acquisition. It's from an economics perspective, it really makes sense to have these locations, and the physical cost of customer acquisition right now is much more affordable than it is digital. And so having these locations is kind of not only a brand awareness perspective, particularly as you situate in kind of these higher end to kind of elevate the brand experience. They really are important from that perspective. So that's why we're continuing to see it now. At the same time too, we are seeing these retailers get more selective with the locations they pick. It's not just a matter of, we're going to open up 50 locations, maybe we're going to pare back and be more selective with 25 locations, particularly as it's gotten more expensive to open and operate in some of these higher end Class A type real estate establishments. So it's going to be interesting to see. I mean, I think that, a lot of these brands are finding out that it's, the game has changed quite a bit, and in terms of digital acquisition, and now you really have to focus on getting the storefront. And it's not just a matter of having the store in the right location; it comes down to have that right experience too. And I think that's been a struggle for some of these retailers as well.
Yeah, I mean, I think there's also other elements. We need to remember there's challenges that have faced everybody. So labor shortages are going to impact, especially if you're newer to the mix, especially if you probably needed physical stores to do more because they're like a newer piece. I feel much more bullish about, not all of them, obviously there's different ones that you're going to feel different levels of strength about what they're going to do in the long term. But overall, this DNB wave is not going to go away. It might be, you might see less stores per brand, but I think you're going to see the shift because of exactly what you mentioned, the cost of advertising, but also the cost of distribution, other values I can get from a location cutting down the cost of returns. If it's a place that I can say, hey, if you return it to this location, it costs X, whereas if you return it online, that's a really important piece of the puzzle for them, because that is a super big expense that they're taking on. I don't think you're going to see any change in these strategies. I mean, you will see a shift in these strategies, but I think this kind of wave is not going to dissipate. I think
No.
it's going to strengthen, and I think we're going to see it pay off, not necessarily in the next 6 months, but in the next year or two.
Yeah, I agree with that too. I think that if you look at the brands that are out there, the digital native brands that I've spoken to, I mean, they are still looking for real estate. The physical stores are still certainly part of it, and you named off a number of the reasons for it too. So I think this trend is here. How that's exactly going to turn out. I mean, it's going to be interesting to see. But I do think that we're going to see more brands explore physical stores as an avenue.
Amazing. All right. I want to get to our last slide, and then we'll get to a few more questions before we have to kind of wrap up. We've talked a lot about, the suburban wave. And I think one of the things that has gotten, we talk so much about how good the suburbs are. There's almost this assumption that the urban area is in for it. What is the prognosis for urban retail? Do you think it'll come back? How long do you think it will take?
Yeah, I do think, and it's interesting if you look at urban locations. I mean, I think you have to take a look at almost neighborhood by neighborhood, or kind of market by market within that urban setting. We've got stats on, if you look at urban business centers. In most markets, that's still down, and it can be anywhere from 10 to 40% below what we were doing in pre-pandemic times. But one of the interesting things, particularly if you look at New York, like the Soho neighborhood there, or Fulton Market in the Chicago market, we are starting to see visitations that are right back where we were, in some cases even higher than where we were in 2019. So the idea that urban retail is dead, I think is probably not the right way to think about it. I think the idea is that where you situate, it's got to maybe change, maybe less focus on urban business areas, but certainly urban residential, particularly in a lot of these markets too, where maybe you saw some of the older population migrate away to the Florida, Texases, Carolinas of the U.S. And backfilled with younger consumers. There really still is a purpose for urban residential areas and retail in those markets. It's a little bit what we talked about with neighborhood retail there. That's kind of where we're seeing some success stories there with these smaller formats in these markets. So I do think that there is still a ton of opportunity for urban retail. You may need to explore different formats, these smaller format stores, these Bloomie's type locations, but it still works in a lot of cases too. The other thing too is keep in mind a lot of these markets too. I mean, we've got Dallas on here. That certainly was one of the markets that saw a big population boost because of migration patterns. Phoenix, Tampa, a lot of markets there, but then also some of these other smaller markets in kind of these regions too, kind of the suburb areas in these as well. So it's interesting to see, but urban is really important. I think that there's still a lot of reasons to have urban residential areas as part of your real estate plans going forward.
This might be completely wrong, but I can't get over the idea that, do we really think these places aren't going to come back? We think these central business areas in New York City, we don't think they're going to return. We don't think we're going to see this continued kind of equilibrium finding process take place. Just feel like we're going to see someone take a gamble on those locations now and really benefit from it. Obviously there's areas, to feel better about. Every area is different. And there's some urban areas that feel like, a bubble popped, and now they're going to find a new, maybe lesser equilibrium, whilst others, not a bubble, but they're in a better situation than they were prior. But some of these major areas, that it's just really hard to believe that we're going to see this extended downturn. At least for me, that doesn't mean I'm right. I want to get to a couple more questions before we have to wrap up. We got one that come in that said, and this is super interesting. One of the things people hoarded during COVID was money. Have we worked through all the hoarded cash, and are we back to normal consumption patterns, or is this there's this added wave for potential spending?
Yeah, if I looked at the savings rates, we are below where we were last year. People, you're right, absolutely, we're hoarding cash, particularly among that higher end audience. And I talked about housing prices being one of the factors that's continued to allow that higher end consumer to spend. We've seen savings rates go down, but I think it's been largely more of the lower end consumer that savings rate's been eroded away by inflation and other factors. But that high end consumer still, if you're looking at kind of savings balances, is still generally in a pretty healthy position. So I think that's a factor. factor that's going to continue to allow consumers to spend. So I think if you're looking kind of, putting your odds on a full-blown recession, I would certainly say savings rates, while being down year over year, is still in a position that kind of puts it in, more of kind of a temporary situation than kind of a long-term recession type, probability there too. So I think that is something to keep an eye on. That lower income consumer is probably, seeing a little bit more pressure on that savings rate than that higher end consumer, but that is another factor that is keeping that high end consumers coming back to a lot of, luxury and other, high end retailers.
Interesting. A question came in also about mall performance. We actually just put out our mall index that covered June. It came out yesterday. Basically, what we're seeing is outlet malls are feeling it the most, and I think that's because of the distance you have to travel to get there. So while their value orientation is well suited to this environment, very often they're like set out a little bit, and that creates a challenge right now. We did see a more difficult month in June than we saw in May, though. When you look at weekly visits by the end of the month, things were starting to improve a little bit for indoor malls and open air lifestyle centers. I think we have a big question coming in the next couple of weeks. We are tracking July really closely. I think last year where you saw really strong numbers was July and early August before kind of Delta hit mid-month. That's where we're going to have, it's a very high standard. So if we see those visits close to where they were a year ago, let alone at or above, then you can feel really confident. I do expect that they're going to continue to be somewhat down. RJ, I don't know if you feel differently.
Yeah, I think that's the way I'm thinking about it too. I mean, I think that there's not enough that's changed in the overall environment. If we saw a major reversal in inflation or big rebound in the stock market, maybe I feel a bit differently. But honestly, if we look kind of beginning of July versus beginning of June, not a lot has changed, to be honest. So I think that to expect a continuation of a lot of the trends. So I think you're thinking about it the right way.
All right. And with that, everyone, thank you so much for joining us. This was so much to do. Please look out. We're going to be releasing, hopefully by the end of this week or early next week, we're going to be releasing a white paper based on the same kind of information we've been discussing today, fleshing out some of the ideas and the things that we've seen from the first half of the year. Please also look out. In a few weeks, we're going to be having a webinar focused on innovation within the retail real estate space. That should be really fun. So please join us then. Thank you so much, RJ, for being here.
Thanks.
And then RJ, we're gonna do this hopefully again soon when we look at we have I will be cryptic, but we have a very cool new thing that we're going to be discussing and basically discussing for the first time on the webinar. So keep your eyes open for that. And thanks everyone, and have a wonderful rest of your day.
Thank you.